Hi, how you doing, Tim?
Good. How are you?
I'm good. Um, we have one other person on the line with us who is not able to speak to us. So, tell me what you're thinking about doing and what made you sign up for this.
Um, I read Ami's
Yeah,
newsletter this morning,
I see. Okay,
and
good.
it talked about uh, expansion loan, SBA expansion loan with 0% down.
Right. Yep. Are you thinking about buying a business?
Yes,
And if the business is in the same NAICS code, it's considered an expansion. So,
yes.
okay, well,
And
yeah, we'll talk about that. Yeah. If you do an expansion loan, you can qualify for SBA. Doesn't mean the banks aren't going to want you to put money down, but the SBA would guarantee a loan. And that's what multi-funding does, is try to help you find the bank that does it. Hi, Rob. You want to
Hi, Rob.
unmute?
Good morning. Please
Good
unmute
morning. How are
yourself.
you?
Hi, Rob. How you doing? Lynn
Doing
Ozer.
well. I'm
Lynn,
going to stay muted. We've got construction next to our building, and so those aren't woodpeckers. Those are uh, ho-rams, and it will drive you nuts like it's driving us nuts.
That's okay. I just wanted to make sure you knew you could unmute any time during the presentation that you want to talk to me. I was just curious, are you thinking about buying a business, starting a business, expanding a business? Just
Yeah,
curious.
we're actually in the process of acquiring one of our competitors,
Oh, awesome.
and
Okay.
so from I guess it was a couple months ago, you did one on the SBA EPCOC program,
Right. Right.
and that was real helpful and good
Oh,
timing.
good.
And then when our competitor reached out, that's kind of the path we're going down. And so again, this presentation you're doing is just excellent timing for
Oh,
us.
terrific. Terrific. Okay. Well, we'll get started. Lydia, if you don't have a microphone and you have any questions, you can always put them in the chat. MJ is my very helpful producer here and will gladly read the questions to me
Yes.
anytime. So feel free
Um,
to do that. Or Rob or Tim, you can unmute and talk to me whenever you want. So, or raise your hand or whatever. So we will get started. Just a little bit of background on me. I've been doing SBA lending my entire career. I worked for the Small Business Administration. Then I managed SBA lending departments in various size banks in the Mid-Atlantic region for the last 47 years. And I also served as I was the first woman to serve as chair of the National Association of Government Guaranteed Lenders, where I've been teaching lenders how to do SBA loans for over 20 years. And now I am the president of Multifunding, where we help entrepreneurs learn about the programs of the SBA and help them to place their loans, because the best lender for you may not be right in your backyard. Anyway, let's get started. Um, where's my, okay. Why should you know about equity? Well, SBA discontinued their minimum equity requirements. And by the way, MJ, remind me that we have to update this one line. They discontinued their minimum equity requirements except for changes of ownership, and they've put back their minimum equity requirement for a startup business. They now have a 10% minimum equity contribution for both a complete change of ownership and a startup business. And it's really important to understand the equity versus the liability section of your balance sheet, because lenders look at that to see whether or not they're comfortable with how leveraged your business is. They use the ratios on your balance sheet to analyze the trends in your company. And you should be especially concerned with your leveraging when you're doing a startup business, you're buying a new business, and it's still important in your current business if you are looking to access any additional debt. So, equity versus debt. Equity is what you own, and debt is what you owe. So there's a delicate balance between the two. What comprises equity? Cash, non-cash assets, equity partners, gifted funds, proceeds from a 401k rollover, standby debt. Those are the things we're going to talk about at the beginning of this. But first, we're going to take a quick look at the balance sheet. And I hope that I am in no way talking down to any of you, but it's very important that you understand your balance sheet. And it's called a balance sheet because it balances. The assets equal the other side, which is the liabilities and the equity. So the total assets in this company are 853,000. It's comprised of current assets of 328 and 500 $525,000 of fixed assets and intangibles, which are the goodwill in this particular case. The liabilities are the debts of the company. The short-term or current liabilities are 135,000. The long-term are 400,000. You have a total of 535,000 of liabilities and $300,000 of 318,000 of equity, which is 50,000 of common stock, and the retained earnings in the company of 268,000. The assets equal the liabilities and the net worth. This is going to be our starting balance sheet in several of the conversations that we're going to have going forward. So, the equity requirement for 7A loans, 10% for startups, no specific equity requirements for a real estate purchase. Oh, I didn't mean to do that. I meant to go backwards. Well, whatever. Okay. I know sometimes here we are. The 10% minimum equity for complete change of ownership. When it says no equity required for real estate purchases, what we're saying is in an SBA loan, you do not necessarily need to have a down payment on the real estate that you're purchasing, but sufficient invested equity in your company is required. And that means the bank is looking at the balance sheet of your company to see the ratio of debt to equity at the present time before you take on the acquisition of a new piece of real estate and the debt going along with that. So they don't have a minimum requirement. Most lending institutions do have a minimum requirement, but that's, that remains to be seen depending on who you're working with. Okay, wait. I need to go to the next slide. What? Maybe if I do this. Oh no, I sometimes make this mistake. Yeah.
We
Wait
can
one
wait
second.
for the slide to move, or
Okay.
you can just simply click on escape first on your keyboard,
I did.
and then we'll just wait for a few seconds.
To see if it reloads.
Yes, because I think your computer is.
My computer froze. Is that what happened?
Yeah,
Oh,
yeah.
no. Okay. That's annoying. We're going to look at the comparison of the balance sheet when it comes to putting in an equity requirement versus a down payment and how that affects the balance sheet and the equity section of your balance sheet. So let's see.
Can you try to on your keyboard, can you
Yeah.
use the right
Yeah,
arrow?
it's not doing anything. Oh man. Hate when this happens. I'm sorry, everyone. This is really annoying. Should I close out of it altogether?
Can you try to click on escape first on your keyboard?
Just did.
Mm-hmm.
And now try the keyboard one.
Yes. And then
Doing-
can you try to click
Oh,
on
there
the,
we go.
there we
Cash.
go.
That's the first one. Unborrowed cash is a form of equity. If you put it into the business, that's equity. If you borrow cash on a personal basis, and you put that money into the business, it can also count as equity, provided that the loan that you took personally has a repayment source that is outside of the business that you put the money into. Okay. So if you borrowed money, let's say with a home equity loan, and you have a partner or a spouse that can repay that home equity loan without taking money out of the business, then the cash that you borrowed personally and put into the business will stay in the business and the outside source will repay the loan. That also can be considered equity if it's borrowed personally and the repayment source is from other than the business. A non-cash asset would be like, say you have a piece of equipment and you're going to use that equipment in your business. So perhaps you are an auto mechanic and you have a digital analytic piece of equipment that you use in your business. And you are going to take that equipment and put it into the business that you're either starting up or buying, and that asset can be appraised, and the value of that asset can be considered equity in the business. Now, you can't put an asset into the business that you can't use. Like some people say, well, what if I put my home in the business? That has equity, but no, you can't put your house into your business. You're not using it, but a non-cash asset that would be used in the business. You can also
Lynn,
take on an equity partner. Yes.
sorry to interrupt you. We do have a question here for
Okay.
non-cash assets. How much do the third-party valuations cost? Do we pay for it or does a lender?
Oh, great question. The third-party business valuation, I mean, asset valuation depends on the asset. Some assets can be appraised for a minimum of maybe $500. Sometimes they're up to $2,500, depending on what it is. The appraisals, just like when you're buying a home, the bank orders it and you, the borrower, pays for it. Now, in an SBA loan, the cost of the appraisals can be added into the total project cost, and you can borrow part of that money from or take that money from the working capital section of your SBA loan. Thanks for the question. The equity partners, if you take on an equity partner, make sure that you keep their ownership below 20%, or they will have to personally guarantee the loan, because that's a requirement of the SBA that anybody that owns 20% or more personally guarantees the loan. The minority equity partner still needs to fill out a personal financial statement, and they have to verify where the funds are coming from that they put in. But the SBA doesn't require a 19% owner to guarantee the loan. Now, I will tell you this, that if you take on an equity partner and they're bringing all the cash into the business and they only own 19%, SBA, not SBA, but the bank is going to see right through that. And more than likely, if they're providing all the equity, SBA, the bank is going to ask them to personally guarantee the loan. Okay, you can also get gifted funds. So someone very close to you who loves you very much could give you money. And as long as they sign a certification that there are no repayment requirements attached to that gift, that money can be considered equity. If you happen to own a 401k and you're not actively employed at that business that has the 401k for you, you could actually roll over that 401k into your equity injection. There's companies out there that we know of that we can refer you to that are experts at doing 401k rollovers to create a C corporation as the borrowing entity. So what they do is they take the funds in your 401k, they use that money to create a new entity, a C corporation, which becomes the borrower. And they have their equity contribution from the funds from the 401k. Now, this is a great way to do this, to utilize those funds. But remember, because you're forming a C corporation, there are certain tax ramifications of being a C corp as opposed to being a subchapter S or an LLC, which is what we usually see small businesses forming as at this point in time. And then there's standby debt. So when we were talking about personal debt, it was debt that was to an individual outside of the business. The business didn't have to repay the loan. But standby debt can be a debt to the business, but it does not have any repayment requirements, I should say, for the life of the loan. And therefore, in the mind of the SBA and the lender, that standby loan can be considered equity because the funds go into the business and there's no repayment attached until the SBA loan is paid off. Now, there's documentation that has to be signed that proves that there's no payment of interest or principal for the life of the loan, and that all of the creditor's rights are subordinated to that of the SBA loan as it lends to, it speaks to payment. No payments come before that to the bank, and no liquidation of the collateral. Proceeds would go first to the SBA and then to the standby creditor, excuse me. Okay. Okay, the source of equity injection, and this is the definition that's provided by the SBA, is new cash or other assets added into the project that are not currently on the balance sheet of the applicant prior to the equity injection. So an equity injection is funds that are not already in the borrowing entity's balance sheet. So let's look at this. This is the balance sheet on the left side that we talked about before. And let's talk about an outside equity contribution. Well, in an outside equity contribution, there's $100,000 put into the business. So you see on the left side, there's $118,000 in cash. On the right side, with a cash contribution of $100,000, the cash goes up by $100,000. So there's $218,000 in cash. The total current assets went from 328 to 428. And the total assets went from 853 to 953,000. Okay. Now, on the flip side, the $100,000 came in as additional paid in capital. Look at the equity section of the balance sheet. There's $100,000 that came in. So the equity section of the balance sheet went from 318,000 on the left balance sheet to 418 on the right balance sheet. The equity contribution increased the equity section of the balance sheet. And the total liabilities and equity went up to 953, so it balances. Okay? That's what an outside equity contribution does to your balance sheet. Oh my. How did I get here? Okay. Now, a down payment, like what we talked about, you might do to purchase real estate, means that you would take the cash out of the cash that's already in the business on the left side. So the cash goes from 118 to the right side where you see the cash goes down to 18. Now, if you were using this $100,000 to put down on the acquisition of a business, let's say, and you used the money from the left side of the left balance sheet, you took 100,000 of cash out, so your current assets went down by 100,000, and you put it into fixed assets and goodwill of the business that you're purchasing. So the long-term assets went up, but the total assets remained the same because the current assets went down, the long-term assets went up, the total assets are $853,000. Now look down to the liabilities section. The liabilities are still 535, and the equity is still $318,000. This is the demonstration of down payment utilizing cash or assets from your existing balance sheet to fund the project. The equity did not change. Remember, in the prior slide, we took $100,000 from outside the business, put it in, and the equity went up. So that's what SBA is talking about when they want an equity contribution. They want the equity section of the balance sheet to go up, not to stay the same. So what if you want to use seller financing as equity? Okay. What if the seller takes back a loan as equity? Well, that's fine, but remember, in an SBA loan now, if the seller is providing equity, first of all, they cannot provide more than half of the required equity. So if the SBA is asking for a $100,000 equity contribution, that means the seller cannot take back more than $50,000. And that $50,000 has to be put in a standby loan. Remember, we talked about a standby note a few minutes ago where there's no payments of principal or interest for the life of the loan. So in this particular case, the seller agreed to do a $50,000 standby note in a subordinated position. So the $50,000 went into the fixed asset portion of the business. So the asset that their $50,000 of loan money went to purchase $50,000 of fixed assets. So you see the fixed assets went from 125 to 175. The total assets went up from 853 to 903. And where did that $50,000 of subordinated debt go? Well, it went on the other side of the balance sheet. In this case, subordinated seller debt for the purpose of SBA financing went into the equity section of the balance sheet, and therefore it increased the total equity from 318 to 368. So the total assets went to 903 and the total liabilities went to 903, and the equity section increased by $50,000. Now, I would be remiss if I didn't tell you that this balance sheet that I'm showing you on the right-hand side is the way that an SBA lender and the SBA look at standby debt, where there's no payment of principal or interest for the life of the SBA loan. Because in reality, according to accounting practices, that debt, that $50,000 of debt, really goes in the liabilities section of the balance sheet because it is a debt. But in the notes to the financial statement, it would say there's no repayment on this loan for at least the 10-year term of the SBA loan. So even though it's in liabilities, there's not going to be principal or interest expended to reduce that debt, which is why they keep it in the equity section of the balance sheet, the subordinated seller debt, until the time that there's repayment attached. Does everyone understand that? How standby debt is actually viewed as equity. All right. Now, for a complete change of ownership, up to 50% of the required equity for the life of the loan is how much the individual has to put in, and it's the maximum amount that the seller can use as subordinated seller debt. Now, in a partial change of ownership, you are able to get 100% financing, 100% of the purchase price, if the business balance sheet, which we were looking at for the most recently completed fiscal year end and current quarter, have a debt to worth ratio no greater than 9-1 prior to the change of ownership. If that isn't the case, then the new or existing owners must contribute cash sufficient to reflect a debt to worth ratio of no greater than 9-1 on the business balance sheet for the current quarter prior to the change of ownership. Or they need to put in 10% of the purchase price, one or the other. They can either put cash in to bring the equity up so that the debt to worth is not more than 9-1, or they can put in 10% of the purchase price. Now, let's
Hey,
see.
Lynn, we
Yes.
do have a wonderful question here about the carry note. Can a seller carry note be part of the structure of the partial change of ownership? And who do the proceeds of the partial change of ownership go to at close? Is it the individual or the business?
Yeah. In a partial change of ownership, the seller could provide 50% of the required equity, just like in the other one, but the seller debt would have to stay in for the life of the SBA loan. Now, the proceeds of the SBA loan go to the owner that is selling their particular shares. That's who gets the proceeds of the loan. But in a partial change of ownership, the debt is on the balance sheet of the business as well as the individual who is buying those shares. They are co-borrowers on the loan in a partial change of ownership. Okay. And the seller has to remain on in the business for at least 2 years or until the loan is current for at least 12 consecutive months, whichever is later. Okay. So that's how long the selling individual has to provide a guarantee if their shares are bought down to less than 20%. Anyone that remains on as an owner over 20% has to guarantee for the life of the SBA loan. Does anybody have questions about that? Well, here, let's look at what the debt to worth ratio is that we're talking about that has to be less than 9-1. This particular balance sheet happens to be extremely healthy. 535 in liabilities, 318,000 in equity. It's a 1.62-1 debt to worth. The liabilities divided by the equity. So this balance sheet is extremely healthy, and you actually could get an SBA loan to purchase part of the business with no money down at all because the debt to worth is less than 9-1. Okay. Let's see. In a partner buyout for a 7A loan to purchase 100% of the purchase price of a partner buyout, the remaining owner must certify that they have been actively participating in the business and have held the same ownership interest for at least 2 years. And additionally, the debt to worth ratio has to be 9-1 or less in the most recent current quarter and the last fiscal year end. So, let's see if we can move this forward yet. Oh my gosh, I don't know why my computer is acting like this today. Here we go. The business balance sheet. So it's just like I said, they have to be in the business. In a partner buyout, the partner that's doing the buying has to have been there for at least 2 years in the same percentage ownership. And the business balance sheet has to have a debt to worth no greater than 9 to 1. Now, if either one of those things are not met, 10% of the purchase price for the partial change of ownership is required by the partner that is buying the business, and or they have to contribute cash to bring the debt to worth down to below 9 to 1. Okay, that's a requirement. Okay. Now, here somebody on this call I know is looking to do an expansion. If you're buying another business and it is going to be a separate structure, okay? If after the loan, both businesses are co-borrowers on the loan, the one that's buying the business and the one that's being bought, and they have the exact same ownership structure after the loan, exactly the same ownership structure, and they are in the same 6-digit NAICS code and in a similar geography, this is considered an expansion. And therefore, there are no outside equity requirements that go along with an expansion. But these are the requirements. It has to be the same NAICS code, you have to have the same ownership, and they have to be co-borrowers located in a similar geography. Now, the SBA allows the lender to consider invested equity in both companies. What does that mean? That's just what we were talking about. We were looking at the balance sheets and we were looking at the debt of the balance sheet and the equity of the balance sheet. If those businesses are not leveraged more than 9 times, and some bankers think 9 is a bit excessive and they want to see it leveraged not more than 5 or 6 times. It all depends on the industry. But if the lender does not feel that the business is too highly leveraged, then they can absolutely utilize this no equity injection at all. If they feel comfortable with the equity that already exists in both the businesses, then the expansion can be financed 100% with an SBA guaranteed loan. Any questions on that? What they don't consider to be equity is the value or the cost of an education. If we have someone who is looking to start a dental practice and they say, well, I just paid $500,000 for dental school. That, even though it might sound like it should be equity, it's not. And the more typical one is when people say, oh, well, my landlord is paying for the tenant improvements to the space that I'm going to be using. Well, let's face it, the landlord is improving the landlord's property. I mean, you are getting a fit out that you can work in, but those assets really aren't yours. And the reimbursement of the borrower by the landlord comes after the first disbursement of the loan. And all equity in an SBA loan needs to go in before the loan is made. So the reimbursement from the landlord comes afterwards, and then the funds that the landlord reimburses the borrower for usually go to pay down the SBA loan. It's not considered equity. Okay, who has questions? We have plenty of time here, and I'd love to answer any questions you have specifically about what's going on in your business. This is
Lynn, thank
also where
you.
you can contact me.
This was super helpful, especially the part about how you define it as an expansion, because yeah, it's the same NAICS code, same geography, and I was thinking, well, I'm just gonna purchase it, drop the assets into the current company, but this tells me that there's a very important reason to keep it as an existing entity so that it can be treated as an expansion loan for some period of time. So I have to drop off to go. Actually, I'm going to be presenting a seminar, but this is really helpful. Thank you.
No, I'm glad. I'm glad you. And if you want copies of these slides, or you can answer, let's see.
Okay, that'd be great. Yeah.
Yeah, there's the QR code. And actually, MJ's going to put something into the chat so you can get the slides or give us our feedback or contact us so we can help you to get your loan. When multi-funding assists you in finding the right bank for your project, we do not charge you, the borrower. The bank that does the loan pays us for the referral. So
Great.
our
Okay.
there are no fees to you, the borrower. So contact us and we can help you get your project done.
Great. Thank you, Lynn.
Oh, you're so welcome.
Bye.
Bye-bye. Anybody else have questions today that we can help you with? Sure, glad.
Lydia and Tim, do you have any more questions? We still have enough time to accommodate your questions, though. And by the way, if you are interested in working with us, or if you want to receive the slides and the recording, please don't forget to fill out our post-webinar form, which I just chatted the link to our webinar chat room. If you have any questions, just let us know too. Any more
Great.
questions from Tim, Lydia?
Happy to help.
I just have one question, Lynn.
Sure.
Just define for me for the expansion, same geographic area.
Oh, Tim, that's a question that everyone asks when they hear this. The point is, SBA feels like if you are running a business, you should be able to get to that other business, to be there physically to run the business. Now, I think you can make an argument for a business that is completely online that you don't need to physically be in the location of the other business. But if there's anything that's location dependent, SBA is going to want to make sure that the expansion is within the same geographic area. I think that is a gray area and can be left up to interpretation, but each lender is going to have a different interpretation of that. What type of business are you in, Tim?
We're in industrial equipment. Specifically, we're a forklift dealer.
Yeah. Well, they're probably going to want you to be in a place where you can, yeah.
What if we have a potential individual in place in that other geographic area that is going to be managing that business for us?
Technically, that SBA would say that's not in the same geographic area if it's not within, a traveling time of where you are now. But if you have someone who's already been in your business, they work in your business and now they're going to be there.
That is correct. Actually worked for us previously.
Yeah.
And we'll be bringing that individual aboard.
You know what? If I was you, I would have the lender that you're thinking of working with. I would have to get the SBA to clarify whether that would be okay or not. So,
Okay.
I mean, it's a forklift dealership, so it's kind of like a car dealership, right?
Well,
But you sell
it's
forklifts.
we sell, service, lease, rent, repair,
Yeah. Oh, okay. Yeah.
all of the above.
Yeah.
And we have, I'm sorry, I didn't mean to interrupt you.
No,
We have the ability to grow our dealership in another part of the country because it's an open territory and we have an individual that is ready to step in, and we're
yeah,
looking at a facility and another company to purchase.
yeah. I do not think, I don't think that SBA is going to go along with that. But you know what, Tim? Send me, if you would, a short email saying exactly what you just said. We have, we want to do an expansion, and it is located, we're located here, it's located there. This person has been in our business, and we're the same NAICS code. We will be co-borrowers. The geography is not the same. Would we be able to qualify as an expansion? And I will send it to the SBA for you.
You had your email address on?
Yeah, it might just be on here, but
Actually,
it's L
actually,
L
actually, I
oh,
just chatted. I just put your email address in the chat room. So
thanks.
Tim, if you could, can you see the message that I sent through chat room? It's lozer@multifunding.com.
Yeah. LOZER at
Mm-hmm.
multifunding.com. It's pretty easy. Okay. And then I'll send that off to the SBA for you.
Okay, and if we are interested in multi-funding to try to help us with this acquisition, we're actually
Absolutely.
we look at one that is in the same geographic area. And then we have the second one that technically sounds like it may be outside the geographic area. Would I come to you or would I go to Ami or?
Yeah. You could come to me, and I personally would not be the person that would do the write-up and stuff, but one of the loan advisors in the business would do that. You can
Okay,
come to either one of us. It doesn't matter. As soon as you're ready to do that, we could definitely do that with you.
okay, great.
Yeah, I mean, you can start with us at any time during the process. Yeah. Because
Yeah.
the advisor will tell you everything that you need to put together so that we can start, the process. But absolutely, yes.
Okay, great. Thank you.
Oh, you're so welcome. All right.
Tim, you can actually use the links, the webinar form that I put there in the chat room to fill out the form, and to, if you want to work with us or to work with one of our senior advisors, that will be the form to be used. And then I'll be the one to set up a schedule for a call between you and one of our supervisors or one of our advisors. Okay,
Very good. I'm filling out the form right now.
perfect. That's great to hear. Any more
Yeah.
questions,
Thanks
Tim?
so much. Yeah. Thank you so much. Thanks, MJ. Sorry about
Thank you.
I apologize for my technical difficulties. I don't know why that
That's
happened
fine.
so
That's
many
all
times
normal.
today. I don't know why.
That's all normal. All right. If you don't have any more questions, Tim or Lydia, thank you so much for attending today's webinar. We hope you found it valuable. Again, please don't forget to fill out our post-webinar form, okay? So have a great day, guys.
Thank you.
Thank you.
Bye-bye.
Bye.